What is momentum investing? Momentum investing is an investment strategy aimed at purchasing securities that have been showing an upward price trend or short-selling securities that have been showing a downward trend. The main rationale behind momentum investing is that once a trend is well established, it's likely to continue. Momentum investing. There is no consensus among economists and finance professionals regarding the validity of a momentum investing strategy. Economists try to explain the effects of momentum investing using the efficient market theory. One hypothesis states that investors bear a significant risk when implementing a momentum investing strategy. Potentially high returns are the reward that counterbalances that risk. Another hypothesis suggests that momentum investors are leveraging the behavioral weaknesses of other investors, such as the tendency to follow the herd, also known as the herd mentality bias. Characteristics of momentum investing. Momentum investing is strictly a technical trading strategy. Unlike fundamental or value investors, momentum investors are not concerned with a company's operational performance. Momentum investors apply technical indicators to the analysis of a security in order to identify trends and gauge the strength of the trend, in other words, to determine the level of price momentum in the market. Momentum investors also seek to analyze, understand, and, if possible, anticipate the behavior of other investors in the market. Awareness of behavioral biases and investor emotions can significantly enhance the effectiveness of a momentum investing strategy. Technical analysis tools in momentum trading. Technical analysis is the primary point of reference for momentum investors. Since traders spend a significant amount of time trying to determine the strength of trends in asset prices, knowledge of key technical indicators is crucial to the successful execution of a momentum trading strategy. Following are some of the technical indicators that are most commonly used in momentum trading. 1. Trend lines. Trend lines are a basic technical analysis tool for monitoring price movements. A trend line is drawn between two successive points on a price chart. If the resulting line is sloping upward, then it indicates that there is a positive, bullish trend, and an investor may buy shares. If the resulting line is downsloping, then the trend is negative or bearish, and selling short is indicated as the most likely profitable position to adopt. Support level trend line in momentum investing. Source: wikicommons.com. 2 Moving averages. A moving average line enables traders to identify the prevailing trend while eliminating much of the market noise that comes from small, insignificant price fluctuations. When a security's price consistently remains at or above a moving average, that indicates the existence of an uptrend. A downtrend is usually reflected on a chart by price maintaining a position at or below a chosen moving average. Moving average momentum. Source: wikicommons.com. 3 Stochastic oscillator. The stochastic oscillator compares an asset's most recent closing price to the prices over a specified period of time. When the closing price is near the high of the price range for the time period, the trend is positive. When the closing price is near the low, this indicates a downward trend. Stochastic oscillator values range from 0 to 100. Higher numbers above 50 indicate a strengthening uptrend. Lower numbers, below 50, indicate a downtrend that is gaining momentum. However, an oscillator reading below 20 indicates oversold conditions in a market that may lead to a market reversal to the upside. Likewise, readings above 80 indicate overbought conditions and the potential for a bearish reversal. Stochastic oscillator momentum investing. Source: vimeo.com. 4 The average directional index, ADX. The average directional index, ADX, is a very popular momentum indicator and one that is generally considered less prone to producing false signals than the stochastic oscillator. The ADX is used to determine A. the existence of a trend and B. the strength of a trend. It does this by calculating the expansion, or contraction, of a security's price range over a specified time period. ADX values range from 0 to 100. Values below 25, some traders use 20 rather than 25, indicate a ranging, or directionless, market in which no clear trend exists. A reading above 25 indicates the existence of a trend, and higher readings beyond that level indicate a stronger trend. In other words, an ADX reading of 40 indicates a stronger trend than an ADX reading of 30. Traders also look for divergence between price movement and the ADX as a sign of waning or weakening momentum. If price makes a new high but the ADX does not reach a new high reading, that is bearish divergence of the ADX from price. On the other end of the scale, if price falls to a new low but the ADX does not see a new low reading, that represents a bullish divergence of the ADX from price. Other popular momentum investing indicators include the Moving Average Convergence Divergence (MACD) indicator and the Relative Strength Index (RSI). How momentum investing works. Traders employing a momentum investing strategy look to profit from either buying or selling short securities when they are strongly trending, i.e., when price action momentum is high. High momentum is evidenced by price advancing or declining over a wide range in a relatively short period of time. Markets with high levels of momentum typically show increased volatility as well. Momentum investing is typically short-term investing, as traders are merely looking to capture part of the price movement in a trend. A momentum investing trade unfolds as follows. A trader uses technical indicators such as trend lines, moving averages, and specific momentum indicators such as the ADX to identify the existence of a trend. As the trend gains momentum, strengthens, the trader takes a market position in the direction of the trend, buying an uptrend, selling a downtrend. When the momentum of the trend shows signs of weakening, such as a divergence between price action and the movement of momentum indicators such as the MACD or RSI, the trader looks to exit their position, hopefully at a profit, prior to any actual trend reversal. More CFI resources. We hope you've enjoyed reading FI's explanation of momentum investing. CFI is the global provider of the Financial Modeling and Valuation Analyst (FMVA) trademark certification program, designed to teach anyone to become a world-class financial analyst. To learn more, check out the free resources below. Coattail investing. Long and short positions. Investing, a beginner's guide. Trade order timing. What is the money market? The money market is an organized exchange market where participants can lend and borrow short-term, high-quality debt securities with average maturities of 1 year or less. It enables governments, banks, and other large institutions to sell short-term securities to fund their short-term cash flow needs. Money markets also allow individual investors to invest small amounts of money in a low-risk setting. Money market. Some of the instruments traded in the money market include treasury bills, certificates of deposit, commercial paper, federal funds, bills of exchange, and short-term mortgage-backed securities and asset-backed securities. Large corporations with short-term cash flow needs can borrow from the market directly through their dealer, while small companies with excess cash can borrow through money market mutual funds. Individual investors who want to profit from the money market can invest through their money market bank account or a money market mutual fund. A money market mutual fund is a professionally managed fund that buys money market securities on behalf of individual investors. Functions of the money market. The money market contributes to the economic stability and development of a country by providing short-term liquidity to governments, commercial banks, and other large organizations. Investors with excess money that they do not need can invest it in the money market and earn interest. Here are the main functions of the money market. 1. Financing trade. The money market provides financing to local and international traders who are in urgent need of short-term funds. It provides a facility to discount bills of exchange, and this provides immediate financing to pay for goods and services. International traders benefit from the acceptance houses and discount markets. The money market also makes funds available for other units of the economy, such as agriculture and small-scale industries. 2. Central bank policies. The central bank is responsible for guiding the monetary policy of a country and taking measures to ensure a healthy financial system. Through the money market, the central bank can perform its policy-making function efficiently. For example, the short-term interest rates in the money market represent the prevailing conditions in the banking industry and can guide the central bank in developing an appropriate interest rate policy. Also, the integrated money markets help the central bank to influence the sub-markets and implement its monetary policy objectives. 3. Growth of industries. The money market provides an easy avenue where businesses can obtain short-term loans to finance their working capital needs. Due to the large volume of transactions, businesses may experience cash shortages related to buying raw materials, paying employees, or meeting other short-term expenses. Through commercial paper and finance bills, they can easily borrow money on a short-term basis. Although money markets do not provide long-term loans, it influences the capital market and can also help businesses obtain long-term financing. The capital market benchmarks its interest rates based on the prevailing interest rate in the money market. 4. Commercial banks' self-sufficiency. The money market provides commercial banks with a ready market where they can invest their excess reserves and earn interest while maintaining liquidity. Short-term investments, such as bills of exchange, can easily be converted to cash to support customer withdrawals. Also, when faced with liquidity problems, they can borrow from the money market on a short-term basis as an alternative to borrowing from the central bank. The advantage of this is that the money market may charge lower interest rates on short-term loans than the central bank typically does. Types of instruments traded in the money market. Several financial instruments are created for short-term lending and borrowing in the money market. They include 1. Treasury bills. Treasury bills are considered the safest instruments since they are issued with a full guarantee by the United States government. They are issued by the U.S. Treasury regularly to refinance Treasury bills reaching maturity and to finance the federal government's deficits. They come with a maturity of 1, 3, 6, or 12 months. Treasury bills are sold at a discount to their face value, and the difference between the discounted purchase price and face value represents the interest rate. They are purchased by banks, broker-dealers, individual investors, pension funds, insurance companies, and other large institutions. 2. Certificate of deposit, CD. A certificate of deposit, CD, is issued directly by a commercial bank, but it can be purchased through brokerage firms. It comes with a maturity date ranging from 3 months to 5 years and can be issued in any denomination. Most CDs offer a fixed maturity date and interest rate, and they attract a penalty for withdrawing prior to the time of maturity. Just like a bank's checking account, a certificate of deposit is insured by the Federal Deposit Insurance Corporation, FDIC. 3. Commercial paper. Commercial paper is an unsecured loan issued by large institutions or corporations to finance short-term cash flow needs, such as inventory and accounts payables. It is issued at a discount, with the difference between the price and face value of the commercial paper being the profit to the investor. Only institutions with a high credit rating can issue commercial paper, and it is therefore considered a safe investment. Commercial paper is issued in denominations of $100,000 and above. Individual investors can invest in the commercial paper market indirectly through money market funds. Commercial paper comes with a maturity date between 1 month and 9 months. 4. Banker's acceptance. A banker's acceptance is a form of short-term debt that is issued by a firm but guaranteed by a bank. It is created by a drawer, providing the bearer the rights to the money indicated on its face at a specified date. It is often used in international trade because of the benefits to both the drawer and the bearer. The holder of the acceptance may decide to sell it on a secondary market, and investors can profit from the short-term investment. The maturity date usually lies between 1 month and 6 months from the issuing date. 5. Repurchase agreements. A repurchase agreement, repo, is a short-term form of borrowing that involves selling a security with an agreement to repurchase it at a higher price at a later date. It is commonly used by dealers in government securities who sell treasury bills to a lender and agree to repurchase them at an agreed price at a later date. The Federal Reserve buys repurchase agreements as a way of regulating the money supply and bank reserves. The agreement's date of maturity ranges from overnight to 30 days or more. What is strategic financial management? Strategic financial management means not only managing a company's finances but managing them with the intention to succeed, that is, to attain the company's goals and objectives and maximize shareholder value over time. However, before a company can manage itself strategically, it first needs to define its objectives precisely, identify and quantify its available and potential resources, and devise a specific plan to use its finances and other capital resources toward achieving its goals. Strategic financial management is about creating profit for the business and ensuring an acceptable return on investment, ROI. Financial management is accomplished through business financial plans, setting up financial controls, and financial decision-making. Important: strategic management focuses on long-term success and tactical management relates to short-term positioning. Understanding strategic financial management. The operative word, strategic. Financial management itself involves understanding and properly controlling, allocating, and obtaining a company's assets and liabilities, including monitoring operational financing items like expenditures, revenues, accounts receivable and payable, cash flow, and profitability. Strategic financial management encompasses all of the above plus continuous evaluating, planning, and adjusting to keep the company focused and on track toward long-term goals. When a company is managing strategically, it deals with short-term issues on an ad hoc basis in ways that do not derail its long-term vision. Strategic financial management includes assessing and managing a company's capital structure, the mix of debt and equity finance employed, to ensure a company's long-term solvency. Strategic versus tactical financial management. The term strategic refers to financial management practices that are focused on long-term success, as opposed to tactical management decisions, which relate to short-term positioning. If a company is being strategic instead of tactical, then it makes financial decisions based on what it thinks would achieve results ultimately, that is, in the future, which implies that to realize those results, a firm sometimes must tolerate losses in the present. When strategic management is effective. Part of effective strategic financial management thus may involve sacrificing or readjusting short-term goals in order to attain the company's long-term objectives more efficiently. For example, if a company suffered a net loss for the previous year, then it may choose to reduce its asset base through closing facilities or reducing staff, thereby decreasing its operating expenses. Taking such steps may result in restructuring costs or other one-time items that negatively affect the company's finances further in the short term, but which position the company better to succeed in the long term. These short-term versus long-term trade-offs often need to be made with various stakeholders in mind. For instance, shareholders of public companies may discipline management for decisions that negatively affect a company's share price in the short term, even though the long-term health of the company becomes more solid by the same decisions. Key takeaways. Strategic financial management is about creating profit for the business. A financial plan that is strategic focuses on long-term gain. Strategic financial planning varies by company, industry, and sector. The elements of strategic financial management. A company will apply strategic financial management throughout its organizational operations, which involves designing elements that will maximize the firm's financial resources and using them efficiently. Here a firm needs to be creative, as there is no one-size-fits-all approach to strategic management, and each company will devise elements that reflect its own particular needs and goals. However, some of the more common elements of strategic financial management could include the following. Planning. Define objectives precisely. Identify and quantify available and potential resources. Write a specific business financial plan. Budgeting. Help the company function with financial efficiency and reduced waste. Identify areas that incur the most operating costs, or exceed the budgeted cost. Ensure sufficient liquidity to cover operating expenses without tapping external resources. Uncover areas where a firm may invest earnings to achieve goals more effectively. Managing and assessing risk. Identify, analyze, and mitigate uncertainty in investment decisions. Evaluate the potential for financial exposure, examine capital expenditures, CapEx, and workplace policies. Employ risk metrics such as degree of operating leverage calculations, standard deviation, and value at risk, VAR, strategies. Establishing ongoing procedures. Collect and analyze data. Make financial decisions that are consistent. Track and analyze variance, that is, differences between budgeted and actual results. Identify problems and take appropriate corrective actions. Examples of strategies based on industry. Just as financial management strategies will vary from company to company, they also can differ according to industry and sector. Firms that operate in fast-growing industries like information technology or technical services would want to choose strategies that cite their goals for growth and specify movement in a positive direction. Their objectives, for example, might include launching a new product or increasing gross revenue within the next 12 months. On the other hand, companies in slow-growing industries like sugar manufacturing or coal power production could choose objectives that focus on protecting their assets and managing expenses, such as reducing administrative costs by a certain percentage. Compete risk-free with $100,000 in virtual cash. Put your trading skills to the test with our free stock simulator. Compete with thousands of Investopia traders and trade your way to the top. Submit trades in a virtual environment before you start risking your own money. Practice trading strategies so that when you're ready to enter the real market, you've had the practice you need.